Well, good morning, everyone. I hope everyone is doing well today. Thank you for being here on time. I hope to give you a general overview of the key issues impacting the U.S. and the global economies. We're focusing on the areas that will impact the most of our attendees. So let's review a quarter of continued growth. GDP numbers came out this morning, and I'll be going through those in just a few minutes. Continued change, plenty of uncertainty, and plenty of life remains the same. So it's really a mixture of everything going forward. For those of you, I think just about everybody on the screen knows me. I'm Marshall Gunn. When we had our third quarter economic update just 3 months ago, the U.S. economy was beginning to show that it was slowing. Inflation was declining a little bit, and the feds had hit the pause button on raising interest rates. So pause was better than raising. So we were happy with pause. We had unemployment continuing to hover at all-time lows. We were optimistic that the Fed rate adjustments would result in a soft landing. You'll hear more about soft landing as we go through today, and it's a rapidly used term as we seem to be approaching that. We're all adjusting to another new norm. Life seems to be coming all the time with new norms as our economy adjusts, as our spending habits adjust. But it's just a new procedure or process in our way of life. One thing that Americans do is they continue to spend money. They tend to focus on fun with family and friends, travel, entertainment, and even if they're having to spend a lot more than they did pre-pandemic, they're still spending those savings that they were able to pent up during the pandemic period. Of course, if they have student loans, they've had to resume payments on those. We've seen wages rise. That has been a major factor of inflation, but that rate of rising, that increasing, has cooled just a little bit. For Social Security recipients, instead of getting an 8+% bump like there was in 2022, there was a 3.2% increase in benefits. So lots of changes going on that continue to bump those interest rates just a little bit. So what does all this mean? Well, joining us today, as usual, every quarter is my good friend Pat Gauthier from CPS Investment Advisors. He's their chief investment officer. He's a guy I get to listen to every Wednesday morning to bring us our weekly update in the market and tell us what's going on. And so it's always great that I'm able to share some of Patrick's knowledge with us when we have these quarterly economic updates. I can share that with you.
Thank you, Marshall. Always a pleasure to be here, and certainly do appreciate you bearing with us every week and hearing what I have to say on the market. It's hard to believe we're already at January 25th, 2024. I'm happy to be here in Florida and not in Kansas City or Buffalo with the weather we've seen over the past couple weekends there. So we'll give thanks that we're here in Florida where it's warm. When we look at the economy in 2023, it was a pretty solid year, and we'll look at that through the markets. So here's our look at the S&P 500, the Dow Jones, NASDAQ, and even the aggregate bond index for the U.S. Pretty solid returns, as you can see on the right side for the year 2023, but any single year can be an outlier in the market. What we want to do is go back to 2021 and look at a longer time frame. Now, we don't have the COVID numbers there in 2021 that we saw in 2020, but if you got to this point in early 2024 and said, wow, we'd still be positive, in the high teens or low 20% range for the major indices coming out of a year like 2022, I think all of us would have been pretty surprised that we recouped so much of our value in that short amount of time. But I also think that if you look at some of the numbers as of late, you might have thought the NASDAQ would have led the pack with the tech heavy index leading the way. We'll dive into some of those things here in a moment, but surprising to see that the S&P, won the day for the 3 years pretty handily versus the other indices, given how well some of the tech stuff has performed in the last year. And even more surprising is the Dow Jones Industrial Average. If you step back and think about what the Dow is, it's your more industrial companies in nature, usually companies that have been around a longer time, paying healthy, steady dividends, not necessarily all of your high flying tech companies that are going to change the world with AI. But still, if you had stuck with those companies over a 3 year period, you have a pretty comparable return to some of those high flying markets. So, an interesting note with the orange line there that you can still get some pretty positive returns from some of those companies that you might consider more of the slow and steady or more boring companies, if you will. One item to note on the graph is that this is price change. So this is the level change. This is not including dividends or reinvestment. This is simply showing you, if you started at zero, where you would have ended up percentage wise based on the price of your assets. It's important to note that because you see in the green line that the bond index, the Bloomberg US aggregate, actually lost value over the last 3 years. Some of us might be thinking, well, you know, if you have bonds and you lose value, did those companies go bankrupt? Did those governments stop paying their bills? How does a bond lose value? And again, this is strictly price movement. And what has happened over the last 2 years, simply put, is interest rates are rising. So when interest rates rise, the value of your existing bonds goes down. And that's what we've seen in the index. And that's where, bonds are math overall. And you do have to watch your positioning over time to make sure that, that bond instrument that you're buying isn't increasing or decreasing dramatically in value. So there's a lot that goes into that, simply more than simply collecting the coupon from your bonds. So speaking of the tech companies, raise your hand if you've heard the Magnificent Seven over the last year. I think it's on, in the news just about every day, if not 10 times a day. But they drove the story for the S&P 500 for the markets in general in 2023. So this is a nice look at how much of the returns that were attributable to the Magnificent Seven. So if you look at most of the year in 2023, the rest of the S&P, the other 493 companies, were slightly positive, treading water a little bit. And if you had ended the year on November 1st, you would have been roughly even, maybe north a couple percent. But some narratives changed there at the end of the year in the last 2 months, and the rest of the market started to catch up a little bit and put in a pretty strong performance. So we saw, mid 20s in terms of total return for the S&P 500. But if you take that Magnificent Seven out, the top seven stocks in the S&P there, mainly driven by technology and in AI, would have been a much different looking year for most of the year. So kudos to those of us who are invested in a number of those companies, and hopefully we're not jumping in at this point to play catch up with some of those. Really, what 2024 is going to bring is a question of, can they maintain that dominance? Can the AI story really drive those stocks higher? We're paying significant premiums for a couple of those names. Some of the chip makers in that list are trading at 80 times earnings. You do have some other large firms in the 30, 40, 50 times earnings range. And that's simply, hey, what's the price you're paying for $1 of earnings for this company? So hype, if you will, is creeping into those companies. If you see them continue to rise without commensurate earnings increases, you'll know that they're being overbought a little bit. But that'll be one of the main drivers. Can they continue to lead the pack, or will someone or some other area out of those 493 stocks remaining in the S&P step up to try to dethrone them? Typically, you won't see those same seven stocks outperform for multiple years in a row. So history tells us that something else is likely to come take the crown. Not that they can't perform well, but we do want to keep our eyes open for some challengers from different areas of the economy. So let's check in on our good friends, the consumer. Marshall alluded to it as we started, that we will spend our money. We will spend it to experience things. We will spend it for the goods and services that we value. And debt is going to be a theme moving into 2024 as well. So we look at our total debt on the left, housing certainly making up a big portion, and an ever increasing portion with mortgage rates the way they are, and housing prices stabilizing, if not continuing to tick up a little bit. You are starting to see that housing expense become more and more of a household budget. So non-housing debt is also starting to creep up, and we'll look at that on the right side. And student loans, as Marshall mentioned, still an increasing portion of debt. You think, all the talk of forgiveness that came and went, maybe folks would have, started to decrease the rate at which they took out student loans. But it's the nature of economic fears. When the consumer fears a recession or they think they're going to need to improve their job prospects, they will go back to school, and employers will encourage you to increase your education so they can maintain their employees and get more out of them. So when we're looking at student loans increasing, not surprised as we came out of 2009, 2010, folks went back to school. And in COVID, when people were locked down, folks went back to school. And now when you have a year or two worth of recession talk, folks are going to be signing up to take more courses to try to improve their employment prospects. The green bar on the bottom is rather interesting. I know we've talked about this in a couple of sections before, but looking at auto loans as an ever increasing part of the consumer's debt. I know the statistics last year, new car payments were over $1,000 a month last year. So, I mean, if you asked my grandparents about paying $1,000 a month for a car, they'd look at you like you were crazy. But it's becoming more and more normal. The trend of manufacturers making back to bigger vehicles. They're discontinuing a lot of the smaller, more economic models. They're moving to electric. They're moving to bigger vehicles for various reasons, and they will be more expensive. So I don't anticipate your monthly auto loans, that statistic decreasing much. Credit card balances are rather interesting. We'll touch on, household savings in a moment, but as Marshall mentioned, whether we're paying cash or we're paying credit, we are going to spend our dollars until we're not able to. We may get a little bit of that from our federal government, which we'll touch on, but consumers are going to spend. And as you see those credit card balances increase, the nature of interest rates rising is going to play a big role in how fast that can continue to increase. There are various promotions for different things on credit cards, but when the bill comes due, you're going to have to pay it or figure out a way to find that cash from somewhere. So always good to check in on our good friends, the consumer, and how we're stacking up, and hopefully we can get some of those debt trends reversed here in the short term. So a quick spot on the economy. Marshall's going to give you some up-to-date numbers in a moment, but I wanted to highlight the trend of GDP coming out of COVID and moving into 2024. Obviously, a huge spike in 2021. When you shut the economy down, you're going to have to really ramp it up real fast to get it growing again. And we saw that in 2021. And you can look at the numbers decreasing through 2022 as more of a normalization, versus any kind of warning signs in the economy. We got, in the middle of 2022, it got a little interesting as far as, are we going to grow or are we going to see a recession? But consumer pulled us out. A lot of manufacturing started to be brought home. There were a few bills passed that invested some money in the U.S. economy, and we saw it continue to grow. And the numbers that came out this morning will illustrate that again for us. So thumbs down to the economists who anticipated a recession in 2023. They didn't quite reach that, although some of the leading economic indicators do show softening. And that just means that, in my mind, we're in a typical business cycle. When you ramp things up really fast, there's going to be an ebb and a flow. No 1 year is ever spot on the average for the most part, whether that's the markets or the economy or any metric. Statistically, you're not going to hit it right on the nose. You're gonna ebb and flow a little bit, as far as that goes. But the economy is not showing signs that we're ready to enter a recession. What's interesting is on the federal side, the amount of money we've been spending given those economic numbers. So if you take a 30,000 foot view of mainstream economic theory, it's okay for the government to spend a lot of money when they're trying to pull an economy out of a recession or a depression. That's when government intervention typically works, is you shoot that stimulus into the economy and let it run its course. Unfortunately, for the last few years, we've been pumping a lot of stimulus into the economy when unemployment has been extremely low and the economy was growing on its own. So it's interesting that we've continued that spending to this point. And this is a topic that here in 2024 we're going to hear a lot about. You're going to get a lot of versions of it. Anytime you have an election cycle and people are counting on the Fed to reduce interest rates, the federal deficit's going to be an issue. Really, why it's such a big issue is because of the way it's related to GDP. We're coming in somewhere around 120% on the lower right there of total federal debt to GDP. There's a lot of versions of why that number is important, but as interest rates remain high, the moral of the story is how much of our federal tax income needs to be spent on interest payments. And that's a problem that the US is going to eventually have to solve. We've gotten really good at kicking that can down the road, and it'll be a political football for years to come, I imagine. But the more money we have to take out of the economy to pay off our debts, the less our businesses and the structure has to invest and grow for the long term. So I haven't met an economist yet who can pinpoint exactly when that's going to be a very big issue for the US, but I think they're all in agreement for the most part that at some point we're going to have to address that issue, and we're not able to just spend and tax the way we have been. So hopefully we'll start to see some responsible behaviors, some fiscal policy that gets us back in a position where we're not borrowing during the good times. So back to the consumer on the personal savings side, and this is important because we have all that excess money that I mentioned that was pumped into the system over the last few years. So folks like you and me had excess money in our pockets for a little bit. We didn't have anywhere to go and spend it, so we bought some things for our house and bought some goods. Then when we were able to get back out into the world and spend it, we did that. Services spending picked up dramatically. Restaurants reopened, theme parks, things of that nature. So that trend is continuing. People are spending on experiences. People are spending on travel. Whether the planes are safe or not, as we've seen lately, we are going to get in airplanes. We're going to fly around. We're going to drive down the highways and spend our money. But the illustration here is to show that that is starting to trickle out of the system. There is still some excess savings left. The money market balances are at all-time highs, and who can blame me if you're getting 5% on your money market fund for leaving your cash there for a little while and maybe spending on that credit card until it's time to pay it off. But this is an important number to watch, because when we run out of those excess savings and US households don't feel as flush as they do right now, that services spending can start to dwindle. And that's where you'll start to see a little bit of pain on the unemployment side. It's unusual to have it as low as it's been for this long, but usually the retail and the services jobs are the first ones to fall if the American consumers stop spending that kind of money. So good luck to us as consumers. Hopefully we find ways to keep that money in our pockets and invest it wisely for the long term. But certainly interesting to watch those balances change over time and how that affects the way people spend their money. Lastly, we spent a lot of time over the last couple of years talking about the Fed, so I promise this is my only slide on the Federal Reserve. But this is the dot plot. So you've likely seen this on the news or heard someone talk about it. But this is basically an illustration of where the Federal Open Market Committee believes rates will be and where the futures markets have priced them in. So if that's off the deep end in economics and Fed policy, I do apologize, but it's important because there's a disconnect here. So what we have are the blue dots are the median point at which the Open Market Committee thinks rates will be at the end of that year. And the red dot, which is a little harder to see, is the implied rate by the year-end futures prices. So those markets have spot rates for various time frames. So basically, when the blue dots are above the red, the market thinks rates will be lower at the end of that year than the Open Market Committee does. So there's a disconnect there. And we know when things are disconnected in the market, they tend to reprice. The market eventually figures it out and gets the pricing right. So that's what we're watching in terms of interest rates this year. Don't anticipate any cuts here in January. March is where the market is starting to price in a cut, although lately they've started to bring that back to earth as the Fed has come out and continually said that they're not going to cut rates as fast as the market thinks they will. One thing that's interesting on the longer end of the chart is the long-term rate. The Fed still believes that about 2.5% on Fed funds is their long-term desirable rate. So that tells me two things. They do think interest rates have to be a little bit lower to maintain a healthy economy long term, and they do think that their current conditions are a little bit tighter than normal. So interpreting this chart, I would say they're trying to get rates down a little bit, but in an election year and in a year where inflation is a little stickier than they thought it would be, I don't see them cutting rates dramatically this year unless we can prove that inflation has gone away. So that's it on the Fed. We won't bore you with that anymore, and a little touch on the consumer there. And I will stick around and make sure we answer any questions.
Pat, thank you as always. I am going to touch base on one little thing that you mentioned just to kind of accentuate before we move forward. I got what I'll call um, a shy text a minute ago from someone privately in the chat room, and the question uh, became, how does what to why do I be concerned if a PE ratio is higher or lower, and so should I be concerned about that? Well, let me kind of give you a mathematical reference, and I'm going to apologize for the mathematical reference. Let's say that something is selling at a PE ratio of 20. Well, PE is their price to their earnings. So 20 divided into 100 is 5%. So if something has a 20 PE, then you would anticipate, based on their earnings, that you would earn 5% on that stock. Well, if 20 is 5%, 50, using the math, is 2%. So if you're paying a 50 PE based on earnings, you're anticipating a 2% return based on their earnings. Well, why in the world would you pay 50? Well, you're obviously expecting that the earnings and the growth of the company is going to outpace their history. It's a growing company. So you take a company that's very stodgy with a product that the use of that product doesn't fluctuate very rapidly, you'll find that their PE historically in the S&P goes around 15, 16, 17%, somewhere in that slightly upper teens, which if you do that math, that's about a 6 to 7% return on your money based on their earnings. And then you're looking for growth, but suddenly that company isn't going to double their business. It's just they're too mature in their market and it isn't going to happen. Now, in all honesty, when you look at a company that has a PE into the hundreds, you're really betting that that company is just going to be on fire growth wise. So I hope that gives you a little insight into the PE ratio. I know Pat talks about it a lot. I talk about it a lot with clients to help them understand the companies that they have. But I hope you found that a little bit beneficial. And I shifted a little down a rabbit hole, but I thought that was important today. But again, Pat, thank you so much. On the economic update, let's look at some general economic conditions. Where we stand today, inflation is still trending downward. That's a good thing. We've seen it kind of hit the curve and come down. Uh, the political tensions, oh, after New Hampshire this week, it certainly looks like we're going to go through Biden-Trump round two. So we'll see how all that comes about. Um, I'm going to talk a little more on the political tensions in just a couple of minutes. One nice thing, the U.S. did not default on its debt. Congress and the president seem to work things out and kick the can down the road a little bit. So we're moving forward. The U.S. dollar didn't cease to be the world's currency. Corporate earnings didn't collapse. The U.S. economy didn't fall into a recession. The geopolitical tensions, however, are more volatile. Things in Israel have heated up, and I'll talk a little bit about more about that. Interest rates are still relatively low, but stabilizing. Unemployment is still historically low. Demand is still high, and our supply chain, domestically in the US, the supply chains, even with the auto workers strike or strikes, plural, last fall, domestically, the supply chains seem to be fairly good. But we've got a Middle East challenge that I'll discuss as we get into it today. So, one of the things I wanted to touch base on, since this is the annual update, is I had to look back and go, oh, gee, what were our concerns in Q1, Q2, and Q3? In Q1, we still had the geopolitical tension going on with Ukraine and Russia. Inflation, we were just coming off the 2023 horrible inflation. Although it was slowing down, it was still very prevalent on everybody's mind. We got to the second quarter, and oh my goodness, the mid-tier banks are ready to collapse. Silicon Valley Bank was just the tip of the iceberg, and it's going to just be terrible because the mid-tier banks are going to collapse. Didn't happen. We still had the geopolitical tensions. The domestic was beginning to heat up. We were going through the first debt default. That didn't happen. And then lo and behold, we get to Q3, geopolitical picks up. We've got the Hamas and Israel battle going on. And our domestic politics, of course, are beginning to really warm up as we know we're headed to the Iowa caucus and the New Hampshire primary that we've already been through. So that was what we were looking at in the rearview mirror. Here's where we are now. Chairman Powell says we're headed for a soft landing. Well, most economists now think that, gosh, they may just pull it off. And of course, being Marshall, the eternal optimist that I am, let's give them the benefit of the doubt and hope that they do. It appears like they just might do it. But still, economists on the average expect the economy to grow up only about 1% in 2024, about half of what the normal run rate, long-term rate would be, and that job growth will begin to fall. So the labor force will see unemployment pushing from its current 3.7% to maybe as high as 4.3 by the end of the year. I recall from Econ 101 and Professor McDowell explaining that a 5% unemployment rate was considered full employment. So 3.7, 4.3, last time I did the math, that's still below 5. So that keeps the economy at full employment still through the end of 2024. What is Chairman Powell's soft landing? Let me reiterate those. Again, short-term Fed funds increased to 5.5. They achieved that. Unemployment remained less than 5%. That's been achieved. Inflation less than 3. Depending on which numbers you use, we're teetering right there. We could possibly be below 3 by the end of Q1. We're hopeful on that. And positive GDP, not a recession. Well, we came through that today. So whatever you call it, growth has slowed, which is generally a bad thing. But in this case, it's the goal of the Fed. So what they're trying to do, they're accomplishing, or the economy is responding. The question is whether will the growth or the lack of growth, what will that be like for the remainder of 2024 and beyond? Last year, the economists and the Federal Reserve officials predicted that the U.S. economy would be sputtering by now. Oh, it was going to be a recession by Q3 or Q4 of 2023. Well, the opposite happened. Recent economic data shows the economy is still growing despite the higher borrowing costs, despite the resumption of student loan payments, despite the war in Ukraine and in the Middle East. Chairman Powell says there will be growth now for the full year. Not huge growth, but growth. And remember, any growth is good growth. This is increasing the forecasting of a slight recession now has moved to 2025. So that has moved from Q3 of 2023, virtually 18 months down the road, to 2025. I always say this, remember, predicting a recession is a little like predicting rain. You keep making the prediction long enough, it actually occurs. In multiple statements, Chairman Powell has left the door open for future action based on the evolving data that the Fed will be receiving in the coming months, not unlike today receiving the GDP information. In other words, it looks like it's working, but let's just give it a chance. I like that approach. Let's don't get too heavy one way or another. It's just a watchful eye, which is a good thing. The next meeting of the Feds are next week, Tuesday and Wednesday, and then they meet again March 19th and 20th. So we're hopeful that, as he said, we're headed for a soft landing. So hopefully the bull can remain on the feather and slide in, and all will go well. Who knows? Looks like the bull just might make it. So what did happen to GDP? Well, those numbers came out at 8:30 this morning. So this is a hot off the press slide. GDP for 2023 was up 3.3%. I like this graphic because it shows you the hot economy of 2021, the cooling economy of 2023, and the further, or 2022 rather, excuse me, and the further cooling in 2023. But the the expectation here is still it's coming down at a rate that is tolerable and will create the soft landing. Consumers spent on that refilled supply chain of vehicles. They are spending money on online purchases and, of course, dining and entertainment, the things that they spend money on. Question still remains, as Pat alluded to, what happens when the savings are exhausted? Those student loan payments are hitting every month. Credit cards are maxed. Higher interest rates cause financing cars to be a bigger chunk of the monthly budget. Replacing the appliance is a little more expensive. Well, if there's a dollar left, the American consumer will spend it. And they'll probably spend about $1.10, just to be sure. I'm not sure anyone anticipated that dramatic level of growth when the GDP numbers came out at 3.3. Anticipated number was between 2.0 and 2.2. So you're looking at a 50% better than what the economists were predicting. But again, what's normally good news is met with mixed emotions because it may, in my opinion, probably slow the Fed down from lowering interest rates. Keep in mind the watchful eye that, yeah, it's slowing down, but is it slowing down as much as they want it to? I'm not sure. I can't read minds, but I will reference this back for a minute to Pat's earlier slide on the anticipated rate cuts. Of course, those numbers and that polling of the members of the market committee was done prior to this morning's GDP. I would love to hear, okay, what are you thinking now? Would be my first question that I would just have to ask. So we'll see. We'll see. What about inflation? Well, again, the Fed goal, it was hot in 2021. It wasn't too cool in 2022. 2023, 3.4. Okay, we're getting there. It continues to statistically subside. Feels like the gas pump is a little bit better. Not what it was back in 2021-ish, but it sure doesn't seem like it's slowing down at the grocery store. But that's just Marshall's shopping habits. You can't judge on that. Let's go to an expert. Let's talk to Mr. Wilson for a minute. I'll read the caption to you. Mrs. Wilson, of course, with her great philosophical side, we have to remember that money can't buy happiness, and as Mr. Wilson led us, or even what it did last year. So it's good to know that Dennis the Menace is helping us to understand the economy. So, what about political tensions? Well, remember the debt ceiling crisis, the one last fall, and the one this month, and the one that'll come up down the road. The real winners every time are the pork recipients whose votes are purchased. Excuse me. The losers, of course, are the American taxpayers. But once again, Congress managed to kick the can down the road. We heard for months that the resumption of federal student loan payments would be a big deal for the U.S. economy. Thus far, as you can see, it's pretty much been a non-event. We've got the U.S. debt that continues to run rampant and unchecked. Okay, if you've got a pen and paper and you can write down the name, I'm going to give you a name of someone you might want to follow on Instagram or take a look for. It's a friend of mine, fellow JU grad. His name is David, middle initial M. Walker. David is the former U.S. Comptroller General. Basically, David was a CFO for the United States for a decade. He is a large proponent of the U.S. Fiscal Commission Act of 2023. The House Budget Committee passed a bill last Thursday to create a bipartisan fiscal commission designed to keep the federal government from going broke. Whoa, what a concept. This is great. It's called HR Bill 5779, the Fiscal Commission Act of 2023. It has bipartisan support. Passage of the bill marked the first time that the House Budget Committee had passed bipartisan legislation outside of the budget resolutions that keep the doors open for more than a decade. Can you imagine that? The bill creates a bipartisan commission that will tackle the nation's soaring debt and make policy recommendations to Congress. House Republicans are making this bill a priority. Uh, Chairman Arrington said everything is on the table regarding the possible action to slow the government's increasing level of debt. It's now more than $34 trillion. That's bigger than my allowance was when I was growing up as a kid. We'll monitor this one to see if it gets traction. But two things to watch for: David M. Walker and HR 5779. A couple of things for you. And of course, that'll be in the recording if you want to go back and find it later. Well, 3 months ago, when we had our quarterly economic update, the Republicans had 13 candidates, Trump plus 12. Now there are 3, when one basically a non-factor. I'm not sure what Mr. Binkley is hoping to accomplish, but he's in the mix along with, as we know, Nikki Haley and Donald Trump. Trump is leading by a huge majority, as you have seen. So it looks like, barring anything really not on the horizon or visual at this point, Trump will most likely be the Republican nominee. When we last left, when was the last time that an incumbent president didn't get the nomination? I can't remember that. Now, we've had incumbents that didn't get reelected. That was the easy part. But we have Biden, of course, as the incumbent, and we have 3 others that I will just label those 3, in my opinion, as non-factors. It's Biden's to lose at this point. I'm not sure which party Kennedy will have the most impact for or against. The biggest concern with Kennedy, of course, is whether voter apathy or rejection, or what's going to be anticipated in Biden-Trump round 2. Will Kennedy have an impact, or will that voter apathy, or I just can't vote for this person, if that mentality comes along in the election, obviously that's not good for the country. But just think, there are only 284 days of campaign ads left until the election. You know, I saw this slide, I couldn't help but use it, and I can't help but wonder what our forefathers must be thinking about the lack of continuity going on through the country and through the electoral process and through Congress. It just amazes me. So, geopolitical tensions. Well, things haven't changed much since the last quarter. The concept of a truly global economy continues to be more prevalent than ever. The European dependency on Russian energy, Ukrainian wheat, and other products, coupled with the disruption of the Ukrainian production, is already causing nightmares in the Eurozone. The war in Ukraine continues to escalate, and it's basically, as we know, a proxy war between Russia and the West. The Hamas versus Israel. Well, this has now spilled over to really impact the supply chains to Europe. Okay, a quick show of hands. Who gave a hoot about the Houthis until they started making attacks in the Red Sea? Who had even heard of the Houthis before a few weeks ago? Well, I don't have the cameras on, but I'm guessing I don't have too much on a show of hands. Well, they're making a major impact on shipping container costs, which have now skyrocketed after they had declined, and the shipping safety of vessels traveling through the Suez Canal. As a result, ships are now having to navigate around Africa to get to Europe, and of course, this is making supply chain disruptions in the Eurozone. So Europe is having challenges that don't even compare to what we're having to deal with in the US. China continues to support their neighbor Russia and threaten hostilities against Taiwan. North Korea. I wish I could understand the logic or mentality of North Korea, but it's just a perpetual question mark. And of course, OPEC continues to impact oil prices based on their production quota modifications, free enterprise. And you remember that at one point we were talking about the US being totally dependent on oil and being a major exporter. Hopefully, those times will resurface a little better. Interest rates. Well, the 10-year Treasury has dropped almost 20% since last quarter. That's a crucial driver of the U.S. borrowing cost. The 10-year yield has declined about 1% from 5.1 to 4.105 in just the last quarter. We're within 25 basis points from the roughly 3.8 that it was at the start of 2023. So at least we've recovered that adjustment that took place, or we're getting close to recovering that adjustment that took place in 2023. Yields which rise, of course, when bonds and bonds fall. The yields have risen since the start of 2022, and the Federal Reserve, that was when they started raising interest rates to fight inflation. So that's when the yields started, and they look like they peaked, and now they're beginning to decline a little bit more. Near record high home prices around the U.S. continue to make it difficult for first-time buyers to compete. You know, interest rates have tripled since 2021. And so according to my realtor clients, the biggest hurdle is still supply. Existing homeowners aren't willing to give up that 2.5% mortgage to go for the 7.545. The bidding wars have returned. I've seen those occurring in some transactions, but not nearly at the level it recently was. And the new home inventory is beginning to increase just a little bit. Demand for mortgages has cooled dramatically. The pace for the increases has cooled off dramatically as rates have, of course, scared off sellers, buyers, and builders alike. Mortgage refinancing, all but non-existent. Rental demand is beginning to decline a little bit as higher prices in 2023 pushed up rental rates. We understand those are beginning to plateau a little bit. So we'll continue to monitor that. One of our attendees last quarter sent me a message and said, hey, please use that slide again on 30-year mortgages and the interest rates from origination date. So this slide is a repeat from last quarter. It's a great chart that indicates the interest rate by the loan origination date. And you see there aren't a lot of those pre-2010 loans hanging out there anymore. Just being real, it's going to be quite a while before the borrowers below that 5% line are going to go back into the market. Let's just be honest. That's interest rates are going to have to get back down there where you're swapping close before things begin to maneuver again. High mortgage rates are also limiting the inventory just because, again, those owners are not willing to sell. And so new construction will continue to see demand. The number of housing permits to issue single-family homes has continued an upward trend. However, home sales do continue to fall slightly, showing that corner of the economy, most weakened by high interest rates, remains to decline. So we'll see what happens in the coming quarters. Stay with us. We'll tell you more. Help wanted. Well, unemployment ticked up slightly from 2022, but we're still below 2021. We're still below 5%. But strong hiring is fueling new spending. People have jobs, they spend money. By some measures, the labor market got stronger in the fourth quarter as employers continue to add jobs. It's just amazing the resiliency. As Pat alluded to, consumer confidence is declining a little bit. Now, as you look at the chart, you can see, oh, it's up from 2022, but yeah, it's down from 2021. U.S. consumers say they're feeling a little better about the economy besides inflation's negative impact on purchasing power and sentiment, but consumer spending growth has just been remarkably resilient. I had the opportunity to attend an update with some Fidelity economists not too long ago, and they gave us the phrase YOLO, as you only live once generation. That the generation now is under the I'm only going to live once, I'm going to enjoy it. So what how is this happening? What's happening? It's simple. If a consumer has a dollar, they're going to spend it. The latest round of bank earnings show that apprehension still hasn't kept Americans from reaching for their credit cards. They're spending their last cash reserves on traveling and enjoying their one life. We'll have to keep watching to see what happens next as those margins continue to decline. This is a reiteration of Pat's slide on outstanding credit card debt, and you can see the trend is not slowing down. The trend is steeper upward. And in addition, where are they spending it? Well, it's the restaurant and bars, the cars, little on the grocery, but you can see the things that were so prevalent during the COVID and immediately post-COVID, doing the home upgrades and the furniture purchases, all those things, the new home purchasing going on during that time frame, all of that has slowed dramatically. Leading economic indicators. Well, here's the interesting part. If you look at 2021 down to 2023, wow, that's a pretty steep decline. The LEI has contracted by 2.9% over the last 6 months, which is a smaller decrease than the 4.3 over the first half of 2023. So the decrease has slowed down, but we're still having a decrease. I don't know if it's trying to give signs of a recession, maybe around the corner. I'm hoping not. I think it's giving more of a sign that the soft landing is truly a possibility. But the leading economic indicator is an amalgam of economic indicators. You've got jobless claims, manufacturing hours, stock prices, consumer confidence, all these things melding into one indicator, and it's meant to show turning points in the economy. It's been flashing these warning signs. As you can see, we've had decline since the start of 22, and on Monday, the Consumer Confidence Board said it fell for that 22nd consecutive month. Well, that's what the Feds have been looking for. That's 22, 23. They're trying to slow it down. The pace of contraction is lessening. Again, I noted that earlier, but the broad message is still consistent. The Feds want a slowdown, and it looks like the leading economic indicators are saying, yep, you're getting what you asked for. So ordinarily, this might be considered tepid news, but with the Fed goal of slowing the economy, a slightly lower LEI it's actually a good thing. So again, we will keep monitoring that. Well, I generally don't dwell on tax issues. However, since we're at the beginning of the filing season, I had a couple of advanced questions, and so I'll touch on a few key issues. The IRS actually opens for business next Monday, January 29th. Every year, we encourage taxpayers to file early. Why? Well, number one, you're giving them your money interest-free. So file electronically, get your refund faster. Number two is e-filing early helps you protect from tax-related identity theft. Every year we have one or two clients who, when we go to e-file their return, we find out, hey, somebody's already filed it, and it doesn't compare at all to what the real world is. And by the way, they got a fat refund because they filed bogus information. It's a nightmare for the client, and we do all we can to help, but it's still a real challenge. If you're concerned, you can go to the IRS website, www.irs.gov, pretty simple, and click on the Get an IP PIN. This is a tool that gives you a special number that the IRS updates with you every year, and if you don't have that number, you can't play. So you can't file your return, you can't do a lot of things without the IPIN number, so it's an extra layer of protection. In case you missed my interview on the local ABC and NBC affiliates last week, I'm going to go over a couple of key changes for you. Number one, the tax bracket ranges were adjusted for inflation. So if your income is the same as 2022, your tax should be a little bit lower. Unfortunately for itemizers, the $10,000 state and local tax deduction limit is still in effect. Many taxpayers purchased electric vehicles in 2023. Don't forget your tax credit. The same with solar and other energy improvements to your home. 401k limits are up slightly in 2024 to 23,000, plus an additional 7,500 for those age 50 or over. The mileage allowance was boosted in 2024 to 67 cents a mile for business. Obviously, it costs us more to operate those more expensive vehicles. Well, here's one I know you're all dramatically concerned about. The estate tax exemption is up to $13,610,000. So, since most of you have an estate that's greater than that, you would incur estate income taxes. If you're a married couple, your exemption is $27,220,000. So, that's a lot of money. No significant changes in the tax code for the moment, but wait until 2025. There are plenty of provisions that are expiring, and it's going to be interesting. For those of you on Medicare, the IRMA limits have been adjusted for inflation. If you don't know what IRMA is, you're not on Medicare. So check the IRMA limits and see if you might be getting a decrease or an increase in your Medicare premium. Long-term capital gain rates continue to be zero for up to $47,025 if you're single, $94,050 if you're married. After that, it goes to 15%, and then once you cross the $500,000 range, depending on single or joint, rate goes to 20. I know many of the people on the call are very charitable, and they may be receiving RMDs or be over 70 and a half, and as a result, they can donate up to $105,000 directly to charity from their IRAs. So if you're charitable, that is a wonderful option for you. Investing in uncertain times, again, we don't make any recommendations to buy or sell and avoid mentioning specific companies just because that's not what we're here for. We're here to focus on the financial planning aspects. I know every quarter I throw this up because it's amazing. I meet with new clients, met with a new one just the other day who was in their 70s, never had a will in their life, never had a trust, never had any of the documents in place. So we had to talk about just, okay, getting the documents, reviewing their plan, all of the basic things. I mean, literally start from blocking and tackling. So financial independence and security is the key for all of our families, whether when we are living, of course, and then the instructions to our family to handle our affairs when we're not. So stick to the sound economics and financial planning. These things never go out of style. Just stick to the basics. Well, with that in mind, I'm going to open the chat room for questions. If something has come to mind, please help us with those. Pat, I've got one. Let's see. Let me get you unmuted if I could. Can you unmute yourself? Or you need? Yeah, awesome. Pat, a quick question for you from one of our attendees today. Now that the market is endorsing crypto with the new exchange traded fund, should crypto be a part of my asset allocation? And a follow-up to that, what's your take on digital currency versus paper? How's that for loaded out of the box?
Great questions. And to answer the first one, should it be part of your allocation? At this point, we don't believe it should. I think, generally speaking, still far too many unknowns in that space to make it an investable asset class as a true part of your allocation. Do you know some people who made a lot of money in crypto? I imagine you do. I know some people who lost a lot of money in crypto. So there's two sides to that coin. My take on digital currency, we could go on and on about this one, but you really want to refine how you're thinking about that, because if you take a step back and look at the economy in general, we are using digital currency. There aren't enough physical dollars in the world to cover all the dollars that circulate through the financial system. Most of us use credit and debit cards or buy things electronically. So digital currency is already a thing. And I think what most people mean is is the Fed going to give us a digital dollar and be able to control it and take it away electronically? I think we're much further from that point than a lot of the headline grabbers would make you believe. But the world moves digital money all over the place every day. So I'm not too scared about digital money It's just a matter of, is it going to be Bitcoin? Is it going to be a US dollar digital currency? 30 years from now, 50 years from now, we'll know. But I don't think Bitcoin in your portfolio is something you can really count on in the near term to help you generate wealth or live your lifestyle in retirement. It's far too volatile. If you're a person who likes the casino and you want to allocate some of your casino budget towards Bitcoin, be my guest. But anything above and beyond that, I would have a serious conversation about your expectations there. I hope that helps.
That's great, Pat. No, appreciate that very much. Another question that was sent in is if Trump is elected and results in chaos, again, I try to stay apolitical. This is a legit question. How will that affect our investments? Well, let me answer it this way. First, the question implies that there wouldn't be chaos if he wasn't elected. All I can ask you to do is look in the rearview mirror. Roughly 3 years ago to January 2021, we had chaos when he wasn't elected. So I think that the lack of trust from both parties, a country that is just so evenly divided and in many cases hostilely divided, there will be some form of chaos either way. I think that's just you can set your sundial for that one. However, keep in mind over the long term, it is policy, not politics, that drive the economy, and the economy drives the market. It isn't as much about who lives in the White House, but how are the House, Senate, and White House controlled? If there's a balance of power, not much will get accomplished on the policy side, but there'll be lots of politics to scare the market. We will hear the government shutting down. We will hear the fear of the currency. We will hear all the fears that we have heard in the past. We'll get to hear those again. So the best advice that I can give you, and again, these are not recommendations to buy. These are just, think about this. Build your investment portfolio with companies whose profits are not tied to politics. Regardless of who's in the White House, people will continue to use Charmin. They'll continue to eat. They'll continue to take their drugs, and they won't stop using the internet and the cell phone. We've watched this. It was battle tested 4 years ago when we went through COVID. And so it's only a case that these things will continue. All right, our next scheduled session, our first quarter economic update, will be held on Thursday, April 25th, 2024 at 10 o'clock. I'm certain it will be interesting. So thank you for joining us. Look forward to meeting with you as tax season progresses. And thank you once again for attending. Take care. Stay safe.